Right now, somewhere in America, a regular person is staring at a brokerage app, watching a number turn green, and they are convinced they just got rich. They didn't. What they're actually looking at is the calm before a wave that has already wiped out millions of investors before them. And almost none of them saw it coming, because the thing that destroys them isn't a crash, isn't a scandal, isn't even bad news. It's a date on a calendar that nobody told them to circle. And somewhere else in the world, a small number of people already know exactly when that date is. They've known for months. They are not panicking. They are positioning. That gap between the people who know the date and the people who don't is where fortunes are made and erased. And by the end of this video, you're going to know which side of that gap you're standing on. This is the story of how one rocket company just helped create the fastest concentration of personal wealth in human history, why a single mechanism buried in financial paperwork is about to test millions of new investors, and why almost no one talking about this on the news is explaining the part that actually matters. Because here's the twist nobody's telling you. The same mechanism that's about to blindside retail investors is the exact same mechanism a 19th century oil tycoon used to break the most powerful transportation monopoly in American history. Stick with me, it connects. And once you see it, you will never look at an IPO the same way again. Let's start with the headline that broke the internet this week. A rocket company, one that, not long ago, was still better known for blowing up test vehicles on live streams than for making anyone rich, went public. And almost overnight, the math around one man's net worth stopped making sense to ordinary people. In a single trading day, the founder's paper wealth grew by an amount that took the greatest investor of the last century an entire lifetime to build. Let that sink in for a second, because it's not a metaphor. It's closer to literal. One man spent over 60 years compounding a few $1,000s into one of the largest fortunes ever assembled through patient, unglamorous investing in real businesses, buying companies, holding them, letting time do the work. Another man, in the time it takes to fly from New York to Los Angeles, generated more new wealth on paper than that lifetime total. Now, your instinct is probably to think, that's insane. The stock market is broken. This is unsustainable. And you might be right. But that's not actually the dangerous part of this story. The dangerous part is something almost nobody is talking about. A clock that started ticking the moment that stock began trading, and it is set to go off in waves for months, completely invisible to anyone who isn't watching for it. To understand why that clock matters more than the headline number, we need to rewind, not to this IPO, but to a different one that already happened, one where the ending is already public knowledge. Because if you understand what happened there, you will understand exactly what's coming next. Here's something almost nobody explains clearly when a hot company goes public. On day one, you are not actually allowed to buy most of the company. When a company IPOs, only a small slice of its total shares are released to the public market. The rest, usually the vast majority, are sitting in the hands of early investors, employees, and executives who are legally barred from selling for a fixed window of time. That window is called a lockup period, and in most cases, it runs around 6 months. For 6 months, the float, the actual number of shares available to trade, stays artificially small. Small float plus enormous demand equals a price that can rocket upward in days because there simply aren't enough shares to satisfy everyone who wants in. That's the part everyone sees, the exciting part, the green candle part. Here's the part almost nobody sees coming. The moment that lockup window starts expiring, all those insiders, the ones who got in years before the IPO, often at a tiny fraction of the current price, are suddenly free to sell. And they don't sell all at once. It happens in scheduled waves, tied to specific price and time triggers, like a series of trapdoors opening one after another. The first trapdoor might release just a few % of total shares. It barely moves the market. People relax. They think the hard part is over. Then 30, 60, 90 days later, a second trapdoor opens. And this one isn't a few percent. It's sometimes 5, 10, even 20 times larger than the first. And here's the question almost no retail investor asks themselves before they buy a hot IPO: who is on the other side of that trapdoor? And what are they planning to do? Because the people holding those locked up shares didn't buy them at the IPO price. Many of them bought in years earlier, sometimes at a 10th or a 20th of the price you're paying today. To them, a 50% pullback from the IPO high isn't a disaster. It's still one of the best trades of their life. To you, buying near the top with no idea this wave is coming, that same pullback can wipe out half your position. This is not a conspiracy. It's not insider trading. It's completely legal, fully disclosed in public filings that almost nobody reads, and it happens with mechanical, predictable regularity. And here's where it gets uncomfortable. This exact pattern has already played out in public in a way you can go verify yourself with a company everyone reading this has used today. In the spring of 2012, a social media company that had become a verb went public in what was, at the time, one of the most hyped IPOs in history. Everyone wanted in. The stock opened high, wobbled, and for a while seemed to be holding its ground. Then summer came, and one by one, the lockup trapdoors started opening. Hundreds of millions of shares, held by early employees and venture investors who had been waiting years for liquidity, became eligible to sell. Not all at once. In scheduled tranches, spaced out over months, each one larger than the last. By the time the largest tranche hit the market that fall, the stock had fallen more than 50% from its opening price. Not because the company was failing, not because the news was bad, because supply overwhelmed demand, exactly the way it was always mathematically destined to, on a schedule that had been sitting in public filings the entire time. The people who got crushed were the retail investors who bought near the top, celebrated the early gains, and had no idea a second, third, and fourth wave of selling pressure was scheduled to arrive. The people who did fine, sometimes spectacularly well, were the ones who understood the lockup calendar before they ever placed a trade. Now here's where this story gets strange, because the exact same psychology, insiders quietly working around a system the public doesn't fully understand, shows up almost a century and a half earlier in an industry that had nothing to do with stocks at all. In the late 1800s, one of the most powerful forces in the American economy wasn't oil. It was the railroads. If you wanted to move oil from where it was drilled to where it was sold, you paid the railroads whatever they demanded because they controlled the only practical way to move it. One oil refiner got tired of paying that toll, so he didn't fight the railroads on their own terms. He built pipelines, an entirely new system that bypassed the railroads completely. Within years, the company that controlled those pipelines didn't just save money. It became dominant enough to shape an entire industry, eventually growing into one of the largest and most controversial business empires in American history. The lesson underneath both of these stories, the social media, IPO, and the oil pipeline, is the same lesson, just wearing different clothes. The people who understand the structure of a system always have an advantage over the people who only see the headline. The railroads thought they controlled oil transportation because they controlled the visible infrastructure. They didn't see the pipeline being built underneath them until it was already operational. The retail investors in 2012 thought they understood the stock because they could see the price. They didn't see the lockup calendar sitting quietly in the prospectus, counting down. And right now, in this rocket company stock, there is a lockup calendar doing the exact same countdown. Except this time, it's attached to a wealth event so large, it's about to rewrite what rich even means. Let's talk about how you actually become the richest person who has ever lived, because the mechanism is not what most people assume. It's tempting to think wealth like this comes purely from salary, or from selling products, or from some single brilliant trade. It doesn't. At this scale, wealth is created through equity. Ownership stakes structured years in advance, often tied to specific performance milestones the company has to hit. In this case, a huge slice of the founder's fortune isn't sitting in a bank account. It's tied up in compensation packages explicitly designed to reward hitting enormous, almost absurd-sounding targets. Market capitalization thresholds in the trillions, production milestones, infrastructure build-outs measured in scales that sound more like science fiction than a quarterly earnings call. When the market suddenly re-rates the company's value upward, because of a successful IPO, a strategic announcement, or simply a wave of enthusiasm, those performance-linked shares can vest, instantly converting paper milestones into paper wealth on a scale that breaks our normal intuitions about money. This is why a single trading day can generate more new wealth than an entire 60-year career of traditional value investing. It's not because one approach is better than the other. It's because they are fundamentally different types of wealth creation, operating on different timelines with different risk profiles. But here's the question that should actually keep you up at night, and it's not, how did he get so rich? It's this: if the same mechanism that creates billions in a single day also exists in reverse, what happens on the day the market re-rates the company downward? Because it works both ways. The same volatility that adds $100 billion in an afternoon can remove it just as fast. A 10% pullback in a multi-trillion-dollar valuation doesn't just dent a fortune. It can erase more wealth in an hour than most companies are worth in their entire existence. This is the part the headlines don't dwell on, because richest person in history is a much better headline than extremely concentrated, extremely volatile paper wealth tied to a single company's stock price. But both descriptions are true at the same time, of the same fortune, on the same day. And underneath all of that volatility, that same lockup calendar from earlier is still quietly counting down. Early investors who got in at a fraction of today's price are watching the same trapdoors. 30% above IPO price unlocks one tranche. A later date unlocks another, often many times larger. By a date just a few months from now, a meaningful share of the total float could become eligible to hit the market. All at once, all from people who have already made the kind of life-changing returns that make taking profit the obviously rational move. So now you have two forces pointed at each other: a flood of insider shares about to become sellable, and a wave of retail enthusiasm that doesn't know it's coming. Which one wins? History already gave us the answer once. The question is whether this time will be different. And there's a reason smart money is betting it won't be. Let's connect every piece we've laid out, because individually they look like separate stories. Together, they're one story. A founder's net worth exploded, not because of some single magical trade, but because of a structure. Performance-linked equity designed years in advance to convert market milestones into ownership. A small public float meant the stock could rocket upward fast because there weren't enough shares to satisfy demand. The same dynamic that made a certain 2012 social media stock soar in its first days. A lockup calendar, sitting quietly in public filings, guarantees that float is going to expand in scheduled waves for months. The same mechanism that turned that 2012 stock's autumn into a 50% collapse. And underneath both of those modern stories is the oldest lesson in business history. The people who understand the structure of a system, the pipeline beneath the railroad, the calendar beneath the chart, make calm, informed decisions while everyone else reacts to headlines. Here's the revelation that should change how you watch this entire situation play out. The smartest money isn't trying to predict whether this company is good or bad, whether the founder is a genius or reckless, whether the rocket program succeeds or stumbles. Those questions matter for the next decade. They are almost irrelevant for the next 90 days. What the smart money is actually doing, quietly, is mapping out the lockup calendar, tracking the price thresholds that trigger each unlock tranche, and positioning around those dates. Not around vibes, not around headlines, not around how exciting the rocket launches look on television. That's the gap we opened this video with. Some people know the date. Some people don't. And the people who know the date aren't smarter investors in some abstract sense. They just did the unglamorous work of reading the filing instead of reading the headline, which raises an uncomfortable question for anyone who bought this stock purely off excitement. If the smart money's entire strategy right now is built around dates you've never heard of, what exactly is your strategy built around? So what actually happens from here? Let's walk the timeline forward, because this isn't a one-time event. It's a sequence. In the near term, expect volatility that looks irrational if you don't know what's driving it. Prices push toward unlock trigger thresholds, pull back, retest, and push again. Not because of news, but because the market is mechanically working through whether enough shares will become unlockable to trigger the next tranche. A few months out, watch for the first major scheduled unlock, when a meaningful percentage of the total float, previously frozen, becomes tradable in a single window. Historically, this is where stocks that looked unstoppable suddenly discover gravity. Not because anything about the underlying business changed, because the supply of sellable shares changed dramatically, almost overnight. Further out, toward the back half of the year, additional, even larger unlock waves stack on top of each other, compounding the available float multiple times over from where it started on IPO day. If you do the simple math, a stock that IPO'd with only a small, single-digit percentage of its shares actually tradable can, within a matter of months, have 10 or even 20 times that amount eligible to hit the market. That is not a minor technical detail. That is one of the largest single forces that will determine this stock's price action for the rest of the year. And almost none of the people buying it today are pricing that in. Zoom out further, and there's a bigger story here than one company. As performance-linked equity structures like this become more common at the top of corporate America, we're watching a shift in how the largest fortunes in history get built. Less decades of patient compounding, more explosive, milestone-triggered re-ratings. If that trend continues, the gap between people who understand equity structures and people who only watch stock prices is going to widen, not narrow. The tools to build wealth this way aren't secret. They're public. But almost nobody reads them, which means the real question isn't whether this particular stock goes up or down next month. The real question is whether you're going to keep being someone who reacts to the headline or start being someone who reads the calendar before the headline happens. Here's the uncomfortable truth at the center of every story we just told you, from a 19th century pipeline to a 2012 IPO collapse to a rocket company's lockup calendar this year. The systems that move the most money are never hidden. They're published. They're filed. They're sitting in documents almost nobody opens. Financially aware people don't chase headlines. They study structure. They know the difference between a stock that's rising because of genuine demand and a stock that's rising because the float is temporarily small. They know that a lockup date matters more than a launch date. They know that richest person alive and most volatile concentrated net worth alive can be the exact same sentence about the exact same person. You don't need inside information to think this way. You need the discipline to read past the headline, the same way you just did for the last 27 minutes. So here's the only question that actually matters by the end of this video. Now that you know the date exists, are you going to go find out when it is? If this kind of breakdown helped you see the market differently, subscribe, because next time we're tracking exactly which dates on this lockup calendar to watch and what history says happens next.